Turnkey with Morgan Francis, sponsored by Integrity Roofing.
Welcome into Turnkey on Queen City News Plus, your go-to show for everything real estate in the Carolinas. We talk about the latest market trends, do's and don'ts of the industry, and provide expert advice on navigating this dynamic landscape that we call home. I am your host, Morgan Francis, and there's been a lot of news lately surrounding the housing industry. Probably the biggest talker is the idea of a 50-year mortgage that President Donald Trump posted on X, and also some other stuff about Fannie Mae and Freddie Mac. We'll get into all of it, but first, I want to bring in Cole Schweitering. He is a mortgage lender with Atlantic Bay Mortgage Group, and Cole, you're going to kind of brief us on all of this and talk about the pros and the cons, I think, of the 50-year. But thank you so much for coming on Turnkey today.
Yes, Morgan. Thank you so much for having me. I'm excited. There's a lot going on in the housing market right now. We got a lot of proposals for some interesting topics, which we'll talk about today. So yeah, let's jump right into the first topic, if you like.
So the first proposal is the 50-year mortgage. The United States is already kind of with a 30-year pressing the envelope. And I say that because other countries sometimes have a 20-year or 25-year. So the United States has probably one of the longer term terms for mortgages. But this idea that's being proposed of the 50-year, on the surface, politics aside, It would seem that this is disastrous. Is there any positive of the 50-year that you can think of?
Yes, I think the intention of proposing the idea was, the longer the term, right, the more it'll help affordability, right? Mm-hmm. So you're able to stretch that payment out and save a little bit on the monthly payment. But the facts and the numbers suggest something a little different, which we'll go over here in a minute. So outside of that, I honestly think it was just a test through X to see how the market would react. And I think the market showed their opinion that it maybe wasn't a great idea.
So why does there need to be that test? And this is the post that was made. President Roosevelt, the 30-year mortgage, and then you see President Trump on the right proposing the 50-year mortgage. So if it seems like it would be more hurtful for the American home buyer to do a 50-year, and again, we'll get into the numbers in just a little bit, why propose it to begin with? I get the affordability aspect, but it would seem that most of the response would be negative.
Yeah, that's a good question. So I think, the FHFA is probably hearing it from homeowners, right? Mm-hmm. Affordability has been an issue for now a couple of years.
Right.
So I think, they're under the spotlight, and I think they're just kind of tossing out ideas to show individuals that, hey, we're working towards this goal. Mm-hmm. So I don't know. I think the administration almost maybe gets a little bit of a kick out of proposing these ideas. I really don't know if they thought through the numbers. I'm sure they did. They're very intelligent people. But outside of that, I don't know why they necessarily put it out there, except to maybe just see the market reaction.
Right. And this is Bill Pulte, who is the grandson of the founder of Pulte Homes, which is now Pulte Group. He's also the director of the Federal Housing Finance Agency. So he's the one who is oftentimes reposting what Trump has said and kind of doubling down and saying this is something that we're actively looking at. But let's get into the actual numbers of what could be the difference that people see when they agree to a 50-year mortgage versus a 30-year mortgage. So, Cole, talk me through these numbers and what we're actually looking at.
Yeah, so I think with these numbers, what we did is we just took a 30 and a 50-year side by side. I think we based this on a 6.75 rate.
And this is, by the way, this is a $400,000 house.
Correct, yeah, $400,000. Well, actually, $400,000 loan amount.
Right, okay.
So, yeah, $400,000 loan amount. I think we did just 6.75 for the 30 and the 50 side by side. Just to run the numbers here. So you can see the monthly payment difference is only $200 and some change.
And that's the affordability part that we're talking about, is the monthly payment will be lower.
Correct. Yep. That's your affordability part. But you would think on the surface, when you consider a 30 and a 50, you would think there'd be more savings, right?
Right.
Correct. But it's the interest difference, right? Because when you are paying interest over 50 years, it's pretty remarkable, right? You can see with a 30-year, it's about $533,000 in interest over the 30 years.
Just interest.
Just interest, right? Mm-hmm. And so now look at the 50-year,
Mm-hmm.
right? It's almost double the amount of interest. So you're really not saving that much on the monthly payments, but you are paying almost double the interest over 50 years, right?
Well, and your last payment is going to be from a nursing home if you don't sell the home before that. Because, I mean, if you buy the home when you're 35, if you're doing a 50-year mortgage, you're going to be 85 by the time you're done paying that, which, you know, most people don't even finish a full 30-year mortgage plan, right?
Exactly. And that's what I was going to say as well. More than likely, you're never going to hold that 30-year mortgage for the full 30 years or even the 50, right?
Right.
But here's the problem with the 50-year mortgage, right? So even on a 30, a lot of the interest is front-loaded. So meaning that once you get about halfway through that mortgage payment, now the mortgage term, you're really starting to chip away at the principal.
Mm-hmm.
Well, with a 50-year mortgage, it's probably going to take 15 to 20 years before you really start chipping away at the principal loan balance.
Mm-hmm.
So the issue becomes, we're in a higher rate market. So ideally rates come down, you're going to want to refinance. Well, if you're in a 50-year mortgage, you're not really chipping away at that principal loan balance. So it could cause an issue when you go to refinance.
So for people who might be a little confused out there, the principal is the actual, like, your equity in the home.
Correct.
You're actually paying toward the cost of your home.
Correct.
The interest is just pure interest. It's like rent, essentially.
Exactly. Yep.
So at some point, when you first start your mortgage, you're paying a whole lot of interest and a little bit of principal toward your home. And at some point, those cross in the middle. And then toward the end of the loan, you're paying more principal and less interest.
You're 100% right in that. Yep. So interest is the money being paid to the bank, right? For them to lend you the money in the first place. So yeah, it takes quite a while for you to start really chipping away at the principal, even on a 30-year. So I always tell people, the smart thing to do, if you're comfortable with the payment and you can put a couple extra, maybe $100, $200 a month towards principal, it could shave anywhere from like 5 to 7 years off your loan. So I think the rule actually is if you make one extra payment a year towards principal, that will shave 5 to 7 years off your loan, save you a ton of money in interest.
Yeah, that's pretty significant. So for someone who is thinking, looking at the 50-year and thinking, well, that I can afford. I can afford either that the amount on the screen or whatever they're looking at if they're comparing it to a 30-year and thinking, well, I can afford $200 less. Instead of going with a 50-year, what would you suggest to someone who's trying to just bring down that monthly payment? Yeah,
so I don't think the 50-year is the best solution here, right? So one good thing I will say about this market right now here in Charlotte, North Carolina, is buyers have more leverage than they've had in multiple years, okay? So there's more negotiating power. So what I would suggest for an individual who's looking to lower their payment would be to maybe go into a deal and negotiate some seller credits, okay? Now, if we get seller credits, we can use that to offset your closing costs, or we could use that to actually buy down your interest rate, okay? So to get you the savings that way. And there's also some temporary rate buy down strategies, which are pretty neat as well. We can go into if you'd like.
So there's a lot of, financial footwork to bring down that monthly payment.
That's correct. Yeah. I think the power is in the negotiation, getting the money from the seller. I think we can help you with the affordability side of things with a rate buy down, a temporary rate buy down. There's many different ways to do it rather than a 50-year.
We have already established that the 50-year is not ideal, not maybe recommended, right? And probably not something that's actually going to happen. But let's just say we live in a world where it does happen and that it is allowed. What kind of impact could this have? From my perspective, I would think you're just asking for another housing crisis. But I'd love to hear from you on the lending side where you think this would go if it actually happens.
Yeah, so if it happens, I don't know if it's going to quite catch as much steam as it would. I think when people really sit down and analyze the numbers, if you're only saving a couple $100 a month, but you're paying double the interest, I don't really know if it's going to catch much legs in that aspect. And then my fear, right, is, we discussed already, we're in a higher interest rate market. So ideally rates will be coming down in the next couple of years and people are going to want to look to refinance. Somebody that gets themselves into a 50-year mortgage may end up in a pickle when it comes to refinance because they might not have the equity needed to do so, especially since we haven't seen home prices appreciating at quite the rate they were a couple of years ago, right? Things have been leveled out a little bit more. So home values aren't going up as fast and you're not really chipping away at your principal, you're not creating that equity.
Yeah, kind of a buyer beware if this does happen. There's always a catch to something that sounds too good to be true. Would love to move on to the next topic. Very interesting one. We have to take a quick commercial break, but when we come back, releasing Fannie Mae and Freddie Mac from U.S. conservatorship, what that means and why it's being proposed. More Turnkey when we come back. Welcome back to Turnkey on Queen City News Plus. I'm joined today by Cole Schweitering with the Atlantic Bay Mortgage Group. We have talked a lot about the 50-year mortgage and established that it maybe isn't the best idea. But there's also another topic being discussed, and it's bringing Fannie Mae and Freddie Mac out from U.S. conservatorship and having it going public at IPO. That can be very confusing to people who have no idea what Fannie Mae and Freddie Mac even is. So, Cole, if we could start there. What are Fannie Mae and Freddie Mac? What is their purpose?
Yeah, so Fannie Mae and Freddie Mac are the two big investors in conventional loans, okay? So ultimately, the loan is done through Fannie or Freddie. Then they package it up at that point and sell off mortgage-backed securities.
Okay.
Secondary market.
And they're under U.S. conservatorship. Think Britney Spears for in a way. But this all happened in 2008 with the financial crisis, right?
That is correct. Yep. So the financial crisis was really caused by not great lending practices. I mean, some of the mortgages they were doing, I mean, it was only a matter of time before that caught up with them. So like, for example, they were doing mortgages at maybe 100% or even 100% or 110% of the home value, right? Yeah. So the problem was when the market crashed, people's home values went down and now they were underwater. So pretty much at that time, Fannie and Freddie were close to insolvent. So the government stepped in and that's why they went into conservatorship.
So why then? So now it's a government-backed entity. So why then change that and go back to how things were with Fannie Mae and Freddie Mac? Why is this proposal being thrown out there? Yeah,
that's a good question. It's been talked about through multiple administrations. It seems like the Trump administration is very serious about the matter. So ultimately,
they're talking about IPO at the end of this year or maybe early next year, which would be hard to imagine. But yeah, as you mentioned, very serious it sounds like about the topic.
Yes, correct. I'll be curious to see. I think, they'll probably continue to push the timeline back a little bit. There's probably multiple things on the agenda. I don't know if taking them out of conservatorship is the very top one, right? So, but I think the reason they want to return them back to the public sector, if you will, is just due to the tax burden, right? So it's like it's going to free up so much capital from the U.S. government to be able to invest back into other things like budget deficits and whatnot. Because ultimately being backed by the government, if something was to go wrong, the taxpayers have to bail it out, right? So this would be a good way to kind of bring funding back into the government. But I'll be honest with you. I mean, they always talk about they're only going to do it to be sure that there's safety and soundness with the decision. So they're going to slow roll this thing to make sure they do it right because there's a lot of impacts, which we'll talk about. So I'll be curious to see kind of what the timeline ends up being.
So let's say they do go public. I would think that the government would still have a very large stake in the companies if they do go public. Do you know what percentage is being floated around?
Yeah, I don't know the exact percentage. I've heard like 5% is what they're thinking about IPOing.
Okay.
Which would generate, I mean, goodness gracious, billions of dollars back into the treasury if they do that.
So what would be the impact on the average consumer, someone who's looking to buy a home?
Yeah, so I think the fear is mainly on the affordability side of things. So what I mean by that is if it was to go out of conservatorship, the fear is that rates will shoot up. So I've seen some numbers thrown around that, rates could be 0.5% to a 4% higher. Could even go higher than that. So it's going to play with the affordability side there. It will also potentially, in some of these risky areas like Florida and California, people fear that, they may not lend in those markets anymore or there's more risk. So they're going to price that risk in. Another thing I thought that was interesting is private mortgage insurance. So with conventional loans, you put less than 20% down.
Right.
You have private mortgage insurance, right? Well, if these mortgages are not backed by the government anymore, now they become more risk. The private mortgage insurance have to have more capital on hand because of the risk, so they're going to charge higher premiums.
Okay. Or require more money down, you think?
That's correct. They could require more money down as well. So, for the individuals who are looking to buy their first house, a lot of times they don't have the money to be able to put more than 3 or 5% down.
Right.
So the fear is there. If you go back to the public market here, now they can kind of price risk in. They might not do the low down payment programs. They're going to be more conservative on credit scores. So there might not be more affordable housing products out there.
Mm-hmm. Do you think it would get to a point that since it's not backed by the government, that's the proposal at least, that maybe they won't purchase as many loans and there might be more local lenders who keep loans on their books versus selling them?
That very well could be the case because there already are some banks who do balance sheet lending, which is a little different because they don't have to abide by Fannie Freddie guidelines. So they kind of come up with their own rules. But even those banks are going to be a little bit more conservative a lot of the times with qualification standards.
Mm-hmm. So what do you think is more likely to happen? Fannie Mae, Freddie Mac getting released from U.S. conservatorship or the 50-year mortgage?
I think the Fannie and Freddie being released from conservatorship is probably going to happen. It's just, is it going to be a couple months? Is it going to be 10 years from now? Seems like it's been talked about, for 17 years now?
Yeah.
So
it'll
be interesting to see. I don't think the 50 years is going to end up happening. I think that was just put out there to see what the market reaction was, and it seemed like it was a negative reaction.
So on the surface, do you think, releasing Fannie Mae and Freddie Mac would be a good move or a bad move? Just from the kind of the lending side of it, like your experience.
Yeah, I think it's been successful, the 17 years that it's been there, more so from the liquidity side of things, because there's been some markets where maybe if it was public again, they might not give 30-year fix. So I think, it's a system that's not broken. I do think eventually they need to do it. But, as they mentioned, they're going to make sure they do it properly if they do it. And I still think it'll be government backed to some extent. So we'll see what happens. I don't know if it's going to quite have the impact if they take it out, as some may propose when it comes to rates and, lending standards. But history tends to repeat itself. So who's to say that maybe if it does go out, we might get back to 2008 standards with lending? I hope not.
I sure hope not. I hope that we've learned our lesson in that, but I guess you never know. But it's interesting because you were saying 17 years ago, and I'm like, what is he talking about 17 years ago? And then I did the math. I'm like, man, it's already been 17
That's right.
years.
17 years now.
It's crazy to think. There is one other thing I would love to discuss. We do have to take one more commercial break. But when we come back, we're going to talk about this tweet right here. Assumable mortgages, a lot of people know about, but portable mortgages, what does that mean? And how could that impact you? More Turnkey after this. Welcome back to Turnkey on Queen City News Plus. I'm Morgan Francis, joined today by Cole Schweitering with the Atlantic Bay Mortgage Group. Cole, we kind of teased to this before commercial break, is the idea of a portable mortgage. Bill Pulte, the director of the Federal Housing Finance Agency, posted this. I still want to say tweet, but posted this on X that at Fannie and Freddie, which he's on the board, we are evaluating how to do assumable or portable mortgages in a safe and sound manner. Assumable, I think a lot of people are familiar with.
Yep.
What's portable?
Yep. So a portable mortgage, we'll keep this kind of surface level because I don't want to confuse too many people. It's very similar to an assumable loan.
Okay.
Assumable loan kind of stays with the property, if you will. A portable mortgage is kind of what it sounds like. You're able to take your current mortgage with you once you sell the property to a new home.
That is very intriguing to me because, there are so many people who we've talked about this on the news who are rate trapped in their home. They refinanced in 2020-ish, and they're in a 2.5 or 3.5 interest rate. And it's like, I might want to move. Maybe your family's gotten a little bit bigger. You could use the space. But how do you give up an interest rate like that? That would be intriguing to many, I think, to be like, well, if I can take my mortgage with me, what's stopping me?
Yep.
Is it as easy as it sounds?
You're exactly right. You hit the nail on the head, right? It's not as easy as it sounds, okay? There's a little bit of things on the back end that you got to consider. So kind of relating it to an assumable mortgage. When you do an assumable mortgage, typically that mortgage amount is going to be quite a bit less than what they might be selling the property for, right? So you have a gap. Okay, so oftentimes you either got to come up with that down payment or you have to take a second mortgage. All right, so same concept. You bring that mortgage with you. A lot of times you're going to be paying more for the home than what's on your current mortgage loan balance, right? So you got to make up the gap. So you could have to take a second mortgage as well. Not to mention you're going to have to requalify for the loan at that time. So maybe you've had some employment changes for better, for worse. That could cause an issue as well. And then if it's going to be anything like an assumable loans don't happen fast. I mean, it could be 45 to 60 days. So it could take longer to close that loan as well.
Well, let's break that down. So assumable, let's say you're selling your house to me. How much do you have left on your fictionary mortgage?
Yeah, let's just say we have $200,000 left.
$200,000 left. Your home is worth $500,000, let's say, and I want to buy your home, and I'm going to assume your mortgage. Does that mean that I have to come up with, what is that, $300K?
So not quite $300K, right?
Okay.
So typically conventional loan, let's say at 5% down. So the math on 500, you know what I'm saying? So you got to make up the gap from 200,000 to whatever 95% of 500,000 is.
Okay.
Yeah. So a couple $100,000.
It's a significant amount of money versus taking the, whole price of the home and, 5% down on that. Portable mortgage. How would that work? I know you kind of briefly explained it, but really break it down for me.
Yeah. So, well, here's the one thing too, right? So you sell your property. Now you got to go purchase a new property.
Right.
So they say the grace period would be about 30 to 120 days that you would have to be able to secure the new property.
120 I could swallow. 30 days I would be stressed.
It'd be quick, right?
Right.
Yeah, exactly.
Because, you want the right home. You don't want a home.
Correct. So, kind of similar to the assumable, right? Let's just say you're going to buy a $500,000 property. Okay. And your loan is at 3%, but it's a $200,000 loan, right? Now we got a $300,000 gap, okay? So we got to find a way when you go to take that mortgage to the new property, how are we going to make up the difference? Maybe it's cash in pocket, or we have to go take a second mortgage. Typically, second mortgages are going to have a little bit different amortization terms. Might be able to get like a 20-year fixed rate second mortgage. And then oftentimes they're also going to have a higher interest rate as well.
Would there ever be a situation on a second mortgage that you'd have like a balloon payment at the end, or
so the two biggest common ones, right? It would be a home equity line of credit and then a home equity loan. So a line of credit would be more of a variable rate, like it's a line of credit, like it sounds. A home equity loan would be more of like a fixed rate, 10 or 20-year term.
Okay. So the portable, it sounds like a great idea, but you really have to do your research.
Correct. I don't think it's going to be as easy as people think it might be. I think it's, if I had to pick the 50 or the portable, I like the portable idea better.
Okay.
I don't know.
You had me on pins and needles there. I thought you were going to say you'd pick the 50.
No, I like the portable idea better. I think it would be great. I think it really would help out the affordability side of things.
It would get the market moving for sure. You have all these people who are stuck in their homes who aren't leaving because of their mortgage.
Correct. And I think that's what the administration is trying to do, right? They're kind of trying to come up with creative ideas to, increase affordability. However, I would maybe argue that neither of those are the best solution. I think there's other alternatives out there, and I think the market is working fine. The market just takes some time to play its role. And I think, honestly, the bigger issue is potentially the inventory side of things. Because what happens if we increase demand, which is already has, now we have to have the inventory to fulfill that demand. And builders aren't building as much as they were back in 2008. They will start, but they're not in the march of dimes, right? So they're not going to build any more than they need to. So I think there's other solutions out there.
All right, we have like maybe 30 more seconds. Your crystal ball. Everyone always wants to know what the lenders think. Where are the rates headed, and when can I refinance?
Yep. So I will tell everybody, stay patient. The Fed rolls at their own speed. I'm hopeful that maybe come 2026, 2027, we can see some rates with a 5 handle in front of them. So if you're somebody in the high 6s or low 7s, definitely talk with a mortgage lender about what your refinance options could be.
Yeah, maybe get a good deal now and then refinance a little bit later if you're looking to buy a house. Cole, you are a wealth of knowledge. Thank you so much for coming on Turnkey.
Thanks so much, Morgan.
And to everyone else out there, thank you so much for watching. We'll see you next time.
Queen City News Plus. Just search Queen City News on your smart TV's app store.